Recording now.
Thank you. So good afternoon. Welcome to the Maryland Insurance Administration's fourth and final public hearing on requests by specific carriers to increase their long-term care insurance rates in 2020. I'm Kathleen Lorraine, and I serve as the State Insurance Commissioner. Please note that this hearing is being recorded, and it will be available for viewing on the MIA's website, along with any comments submitted in connection with the hearing. We are recording it because of the state of emergency and the pandemic. We are hosting this meeting this time not in person, but through the WebEx events platform. The recording is both visual and audio, and in addition, we do have a court reporter that is making a transcript, and that transcript also will be available on the MIA's website when it has been prepared. So as a matter of housekeeping, let me remind everyone to please keep your speakers muted. And I ask you, please do not place your phone on hold. Unfortunately, this sometimes results in broadcast music coming into the call. I can't stress that enough. If we do start to hear that and it disrupts the hearing, we will unfortunately have to drop you from the call. So today's hearing focuses on several rate increase filings that are currently under review by the MIA. In the individual long-term care market, those filings are a filing from MedAmerica Insurance Company, proposing increases of 25.6% for policies without inflation and increases of 40.1% for policies with inflation, as well as Genworth Life Insurance Company, which is proposing increases of 66.3%. In the group long-term care market, we are reviewing a request from Genworth Life Insurance Company, proposing increases of 65.1%. Combined, these requests affect about 4,054 Maryland policyholders. All of these filings are available on the MIA's website. The goal of today's hearing is for a representative of each insurance company to explain the reasons for the rate increase request and to answer any questions that the MIA may have about the reasons provided. We also want to hear from consumers and other interested parties about the requested increases. Now, this is not a question and answer forum, and we will not take questions from participants, although the MIA panel may ask them of you. If you have submitted comments to the MIA previously, we will call on you and offer you the opportunity to speak today. If you have not previously submitted comments or asked to speak, you may still do so by identifying yourself and any organization that you might represent and asking to be heard. You should do so by typing in the chat section that you would like to speak. And if time permits and the technology works with us, then we will call on you and we'll give you the opportunity to speak. Comments from interested parties were received and reviewed in advance of this meeting. The MIA will keep the record open until Wednesday, November 25th, 2020 for additional written testimony. And as I noted before, the transcript of today's meeting, as well as all written testimony submitted, will be posted on the MIA's website on the long-term care page, which is found at the MIA's website. If you click on the long-term care tab located under quick links, it will take you to that site. And I will repeat that information at the end of this hearing. So as we get ready, let me first introduce the MIA staff members who are here with me today. From the Office of the Chief Actuary, we have Todd Switzer, who is our Chief Actuary, Adam Zimmerman, an Actuary, and Jeff G., a Senior Actuary. In addition, we are joined by David Cooney, our Associate Commissioner of Life and Health, Michael Patty, the Director of Government Relations, and Craig I., who is our Director of Communications. When you speak, please state your name and organization, and if you would, please spell your last name for the court reporter. And I'll now turn this over to Adam Zimmerman, who has a few comments that he would like to make.
Thank you, Commissioner. My name is Adam Zimmerman. I'm an actuary with the Maryland Insurance Administration. And before we get started, I just wanted to go over an overview of the current marketplace of long-term care in Maryland. So year-end 2019 in Maryland, there were 142,000 lives in force that were covered by standalone long-term care policies. In the last decade, between 2010 and 2019 in Maryland, the enrollment for standalone long-term care plans peaked in 2012 when there were approximately 154,600 lives in force. In 2019, in Maryland, the average premium for a long-term care policy was approximately $2,100. And over the last several years, the sale of combination or hybrid products is growing rapidly. For those who are unaware, a combination product combines life insurance or an annuity with long-term care benefits. For nationwide, we don't have Maryland-specific data, but nationwide, in 2018, there were approximately $1.8 billion in premium issued for combination products, compared to approximately $175 million in first-year premium for standalone long-term care products. Another thing that we're looking at is with regard to COVID-19. There may be a shift in how policyholders are receiving care, mainly receiving care at home, as opposed to in nursing homes or assisted living facilities. And so with that being said, one thing I wanted to point out is using Genworth's cost of care survey for 2019. I just wanted to provide a few average costs for different services. So in Maryland, a home health aide was estimated to be approximately $54,912 in 2019. An assisted living facility for a one-bedroom was $51,600. And then compared to nursing home settings, a nursing home or semi-private room was approximately $116,000, and a private room for a nursing home was approximately $120,000. So with the overview of the market completed, I just wanted to talk about a few rate approval histories over the last few years with regards to long-term care. So in 2018, the MIA reviewed and approved 49 long-term care files, with the average request from the companies being 42%, and the average approval granted by the MIA was 16.5%. In 2019, there were 7 files that were received and approved by the MIA, with the average request from the company being 42.8%, and the average approval was 9.4%. And year-to-date 2020, the MIA has reviewed and approved 34 long-term care files. The average request was 70.2%, and the average approval was 32.1%. For those that are unaware, Maryland has a 15% annual rate cap in our regulation, and so from those approvals above, any approval that was over 15% would have been phased in over multiple years, 2 or 3 years as an example. And one thing you'll notice is that in 2020, the MIA has approved larger increases than the average approval in 2019 and 2018. And this is because we've been able to work with companies, unlike more successfully than in 2018 and 2019, to be able to agree to rate guarantee periods after implementation of a rate increase. So what this means is that once a rate increase has been approved and implemented by the company, they have agreed to guarantee or not raise their rates for a certain amount of time. And so far in 2020, we have worked with companies to achieve rate guarantee periods ranging anywhere from 3 years, and we have had one company agree to a lifetime guarantee period after the rate increase had been implemented. And one reason for this change is, approving a single increase year over year potentially, it does not provide consumers as much information about the future of their policy or, the ability to make informed decisions with, should they drop a rider or pay the increase or whatever the case may be. So we're just trying to provide policyholders as much information as possible about the future of their policy premiums and allow them the opportunity to make the most informed decisions. So with that being said, I'll turn it back over to the Commissioner, who I believe we'll call the first panelist up.
Yes, thank you, Adam. I appreciate that. So I think we will first hear from MedAmerica Insurance Company, and I believe that is Patrick Kinney will be speaking on behalf of MedAmerica.
Yes.
Thank you, Mr. Kinney.
Commissioner Brain, Mr. Switzer, Mr. G, Mr. Cooney, Mr. Zimmerman, administration staff, and guests, thank you for the opportunity to appear regarding our long-term care premium rate increase filing. My name is Patrick Kinney, and I am the Director of Long-Term Care Pricing at MedAmerica Insurance Company. MedAmerica sold standalone long-term care policies nationwide from 1987 through early 2016. Although the company ceased sales at that time, we remain committed to provide promised LTC benefits to the nearly 100,000 people across the country, including all the 400 in Maryland, who rely on us to continue their coverage long into the future. Adverse experience in policy persistency, morbidity, and interest earnings threatens the financial health of the LTC industry. MedAmerica is a monoline LTC company with no other insurance products to offset projected shortfalls from long-term care coverage. We believe that further premium rate increases are necessary now to assure our ability to pay LTC claims in the long term. We need to place our closed block LTC products on a sounder financial footing for the future. Today's hearing concerns our requested premium rate increases on our Simplicity 2 product. This policy form was issued in Maryland from 2008 through April 2014. In 2015, we requested an average 25% rate increase nationwide on this policy form due to deteriorating experience projections. The Maryland Insurance Administration allowed a 15% rate increase in December 2015, which took effect in 2016. Follow-up filings allowed for increases of 4.3% in 2018 and 4.2% in 2019, bringing the cumulative rate increase in Maryland up to the 25% nationwide increase level. Since the determination of the need for that initial rate increase of 25% back in 2015, the company has regularly updated its experience studies to include more years of data. In 2019, our updated actuarial projections of the lifetime loss ratio on the Simplicity 2 policy form demonstrated that experience nationwide has been more than moderately adverse compared to our 2015 projections. Under applicable regulatory principles, this demonstration allows the company to request an additional rate increase. As stated in our Actuarial Memorandum, an average rate increase of 38.5% is considered necessary at this time. As of year-end 2019, there are 124 individual Maryland policyholders who would be affected by our rate increase. I recognize that this may seem like a very small block to the administration. MedAmerica is a small company, and we are pursuing a rate increase request on our Simplicity 2 policy forms nationwide. Of all jurisdictions where we are seeking this increase, Maryland is in approximately the 43rd percentile nationwide by in-force premium. Although the annual premium increases we have asked for may therefore seem small in total dollar impact to us, they are not insignificant to the company. And of course, we all understand that any rate increase is significant to our insureds. We believe it is a matter of equity across insureds nationwide that we seek similar or actuarially equivalent rate increases in all states. State-by-state approvals can and do vary dramatically. Nationwide, MedAmerica is requesting a premium rate increase that varies by issue age and inflation option to achieve the same cumulative rate increase, except we're limited by regulatory restrictions. In Maryland, the company is requesting a phased-in rate increase such that no policyholder will receive a rate increase of more than 15% in a single calendar year in order to comply with Maryland regulation. The phased-in increase is approximately actuarially equivalent to the nationwide request described in our Actuarial Memorandum, but varies only by inflation option, if allowed, rather than by issue age and inflation. Our rate request is for a first-year increase of 15% for all insureds. For policies with no automatic inflation protection, a second-year increase of 9.2% would achieve cumulative actuarial equivalence with our nationwide rate request. Because of the greater risk on policies with inflation protection, we are requesting a second-year increase of 15% and a third-year increase of 5.9% in order to reach actuarial equivalence. Implementation of any rate increase will take place no earlier than 1 year after implementation of the prior rate increase, and no policyholder will receive more than one rate increase within 12 months. The Actuarial Memorandum supporting our filing presents the experience analysis and projections justifying the full rate increases we believe to be necessary for illustrative purposes and for consistency with the information provided in other jurisdictions. We feel that this transparency provides Maryland regulators with a more complete picture of the financial risk to the company and the rate actions ultimately considered necessary to mitigate these risks. We feel it would be in the policyholder's best interest if the administration were to approve the requested series of annual increases. That would allow the company to communicate known future rate increases to our insureds, who could then make decisions regarding their policies with a fuller knowledge of future expectations. However, at minimum, we believe a 15% increase is justified for all insureds at this time. MedAmerica will offer insureds affected by any proposed premium increase the option of reducing their policy benefits to provide flexibility of choice for those insureds who wish to maintain a premium level reasonably similar to what they were paying prior to the rate increase. Furthermore, the company is offering a contingent non-forfeiture, or CNF, benefit to all insureds affected by the rate increase, so that a policyholder who lapses premium payments due to the rate increase remains eligible to receive some level of paid-up benefit in the future. To help consumers navigate their options to continue premium payments, accept a reduced paid-up CNF benefit, or find another benefit reduction option that best suits them, our insureds are encouraged to call our toll-free customer service phone number. Because each policy is unique, MedAmerica works with each person individually. Our company takes pride in providing quality claim service to our insureds. 96% of claimants surveyed rate their experience with MedAmerica as above average or excellent, and our average time to pay a claim is 6.4 days. We believe this service excellence is a critical component to fulfilling our promises and taking care of our insureds, and we intend to continue providing this level of service going forward. In closing, I'd like to reiterate that despite the fact that we no longer sell long-term care insurance, MedAmerica is committed to delivering on all of our promises to our customers. Granting actuarially justified rate increases will help assure we have the financial strength to continue providing the benefits and service our insureds expect and deserve. Thank you for your time and consideration. I'm happy to answer any questions at this point.
Thank you. I'm sure that the members of the actuarial team will have questions. I just had one point of factual confirmation. I just want to make sure I understood your testimony correctly. You indicated that your projections were based on nationwide data. Is that nationwide data for this product, for your long-term care book, or more generically?
It's nationwide data for we analyze our data across all of our products and develop assumptions appropriate to each product. So the assumptions supporting this filing are based on the Simplicity 2 product. And I believe we may also look at our Simplicity 1, I guess it's just Simplicity and Simplicity 2 products experienced together because they're very similar cash basis products.
And as you were projecting trend, you were looking at Simplicity 1 and 2?
I believe that's what we do, yes. And then we break it up. We've moved to a predictive analytics system for looking at our experience. It may actually have a different variable for Simplicity and Simplicity 2 at this point, but because the products are similar, they're cash basis products as opposed to reimbursement products, we often look at them similarly.
Okay. Thank you. I just wanted to make sure that I understood what you meant by nationwide data, and I'll turn it over to our actuaries.
This is Todd. I did have a question or two, please.
Yes.
Thank you, Mr. Kinney. So we note that your company runs a relatively lean risk-based capital position. And looking at third quarter financial results, we saw that in first quarter, there's a significant decrease in capital and surplus, 21% decrease. However, in the second quarter, about a 31% increase, and in the third quarter, 27% increase with some material impact to risk-based capital. And again, I recognize that you run a relatively lean position there. So my question is, I know you submitted these filings in August and obviously did the analysis in the months preceding that, August 24th or so. So with the benefit of another quarter of data, a little more time elapsed, do you expect those kinds of results? Do you have a read to continue for a quarter or two, or any commentary in that regard, please?
Well, I believe that we've seen a slight dip in claims in 2020 and that we are considered associated with the COVID-19 situation. We don't expect that to continue into the future. We expect our long-term assumptions will still hold.
Okay, thank you. And one more, I noticed that you updated data in 2015, updated data again in 2019. So is the next one slated for 2023, about a 4-year cycle to do a full data refresh?
We're actually in the process of working with our consultants to move from a claims cost model to a first principles model. I know I'm getting very technical here. So we may well be conducting an update in 2021 or 2022 based on our first principles model.
Got it. That's helpful. Thank you very much. That's it for me.
Jeff, you're on mute.
Hello, Mr. Kinney. This is Jeff G. My question is, if Maryland Insurance Administration cannot approve what you requested, which is 38.5 on average, so what do you have any next plans?
Well, our plans would be to request the follow-up increases at the levels that I outlined in my testimony for year 1, year 2, and year 3. If the approval were to be 15% or less in year 1, we would come back in another year or so for another request to bring us up to the level that we've currently requested.
Okay, thank you.
I believe you're on mute, Commissioner.
Sorry, guys. I was so paying attention to my own rules. So, Adam, did you have any questions?
No, I'm okay for now. Thank you.
Okay, thank you. In that event, Mr. Kinney, thank you for your testimony today. I appreciate it.
Okay.
And we will move on to Jen Worth and to Jamala Arland.
Thank you, Commissioner Bereen. Can you hear me okay? Can you guys hear me okay?
Your volume is a little low, Ms. Arland.
Is that better?
No, still a little bit low. It appears we've lost your video. There you go. Okay.
Unfortunately, we still can't hear you. I think one of the options that you have is to change your audio to your phone. If you want to try that, although I have to say I'm not the tech savvy person on the call by a long shot.
Another option would be to just log back in, because you had good sound when you first got into the meeting. So that would be an option.
And it's okay. Take your time. If you need to do that, that's fine. We have a 3 hours set aside for this hearing. So.
There are three dots at the bottom of the screen, and if you click on that, you might be able to hit select computer audio, which might help. I'm thinking that your best option may be to try to log back in.
I think for me, one of the most challenging things of the pandemic has been the number of different tech platforms that we've all had to learn to navigate, from WebEx to Zoom to Google to Team. I'm sure that for everybody on this call, it's a constant challenge to be able to align the technology and the equipment. So it's been both a blessing and a curse. It keeps us connected and it keeps us moving. But at the same time, it's a challenge to make sure it all works together smoothly.
Okay. Back on?
Come back in again.
Yes. Ms. Arlen? Ms. Arlen, can you hear us? Can you hear us? And when you logged in, did you hit the computer audio? There might have been a dialog box. Ms. Arlen, can you hear us?
Are you able to hear us, Ms. Arlen? I'm not sure that she is. Let me try to send her an email.
Let's see. Ms. Arlen?
Hi there, can you hear me?
Yes, we can hear you. Yes.
Oh gosh, I'm calling in from my phone. I apologize. I'm sorry. I had to move after we initially connected, so I really apologize.
No worries at all. It's our new normal. So we can hear you now, and we're happy to hear from you, both with regard to the individual product and the group product increases that Genworth is requesting.
Thank you so much, and thank you for your patience. Okay. I'm proud of myself. Okay, good afternoon. My name is Jamala Arland, A-R-L-A-N-D, and I'm the Vice President and Actuary in Genworth's Long-Term Care Closed Block Business Unit. I'm an actuary in good standing with the Society of Actuaries and the American Academy of Actuaries. Commissioner Bahrain, thank you and the Maryland Insurance Administrative Team for holding today's virtual hearing and for providing Genworth and our policyholders an opportunity to discuss what is happening with our long-term care insurance policies. I'd like to thank all of the policyholders for your interest and participation. Genworth understands that your long-term care insurance coverage is important to you. We welcome this opportunity to participate in the hearing. During this unprecedented period, Genworth understands that our ability to support, service, and protect you, our policyholders, is of absolute importance. We take this very seriously and affirm our commitment to being there for policyholders when they need us. Genworth has been selling long-term care insurance in the state of Maryland since 1978 and currently provides coverage to approximately 30,000 Maryland policyholders and approximately 1.1 million policyholders nationwide. I'm here today to speak specifically about our current long-term care premium increase filings, which are pending with the Maryland Insurance Administration. Genworth understands how difficult premium increases are to our policyholders, so we welcome this opportunity to provide information that explains why rate increases are needed, and we also want to discuss the various options we offer to policyholders that and the ways that we can assist them in making informed choices about their specific long-term care needs. Genworth is currently seeking the first rate increases on 2 of our newer product series, including an employer group product. So when I use the terminology of policyholder, I intend that to refer to certificate holders in the case of the employer group product. When we price these long-term care insurance policy forms, we utilize professional actuarial judgment to develop assumptions that look as long into the future as 60 years. Genworth, we employs our best effort to complete a thorough professional assessment at the time of original pricing, and we also continue this evaluation of the block on an ongoing basis. Since 2010, claim information has more than doubled for Genworth. We have seen that claims continue to cost more and occur with higher frequency than originally anticipated. While information on claims for newer products is still developing, we have leveraged our experience data to inform our assumption setting. For the assumptions supporting these rate increase requests, Genworth has leveraged significant new claim experience on similar and related product series based on over 11,000 claims in total, and in particular on claims at attained ages of 75. It is our intent to act in a timely manner and work diligently with regulators to obtain approval for the proposed rate increases and seek to avoid more significant rate increases when the average attained age is higher. I want to highlight a few considerations as it relates to COVID-19. Given our industry, we are uniquely positioned to understand the devastating impacts of COVID-19 on some of the most vulnerable in our community, and that's older adults. Considering our average claimant is in their early 80s, we appreciate that this population is at high risk for contracting and suffering serious effects from the coronavirus. Genworth has implemented a comprehensive COVID-19 community outreach plan to assist the most challenged in our communities. We've initiated outreach to local nursing homes and assisted living facilities and created programs to respond to social isolation among seniors. In addition, the Genworth Foundation has made contributions to safety net organizations in the communities in which we have offices, many of which provide care services to the elderly. As a global organization, Genworth has created and maintained business continuity plans across all of our business. And despite the changes we have made to our operations in light of COVID-19 and my sound, Careful planning has allowed us to continue the operation of critical functions, including policyholder administration and, most importantly, the payment of policyholder claims. We have also taken measures to extend grace periods for policyholders who face hardships paying their premiums, and we have been more flexible in accommodating unique situations for eligible claims while continuing the appropriate scrutiny to prevent fraud. Overall, Genworth has observed what it believes to be a temporary decrease in new claims, potentially due to reluctance of insureds moving to facilities and receiving care outside of the home. Publicly available information indicates that this is an industry-wide phenomenon. So while the ongoing impact of COVID-19 is very difficult to predict, the relative outcome and impact to our long-term care business will depend on the length and severity of the pandemic and speed of the economic recovery. It remains too early to tell how recent trends will impact long-term financial results. We continue to track business performance and perform sensitivity analysis to help refine our expectations. Long-term care is a very long-term product, and we project premiums and claims over a 60-year period. Additionally, the majority of Genworth's claims have historically been initiated in the home. Events in any given year, while tragic in and of themselves, are unlikely to have a material change in the overall projections in the future. Our number one goal is to ensure claims paying ability for all of our policyholders, and actuarially based premium rate increases or equivalent policy adjustments are an important component in our ability to do so over the life of the policies. As it relates to the specific rate increase request at this time, Genworth has issued the Flex 1 policies from November 2011 to September 2014 under Policy Form 7052MD. We are seeking our first premium rate increase on this policy form in the amount of 66.3% for all policies. Acknowledging the Maryland regulation, Genworth would be willing to implement the requested increases over 4 years with no more than 15% in each year. This rate increase will impact approximately 3,500 policies. Impacted policyholders have not received any prior rate increases. On the Flex 1 product, Genworth will continue to evaluate whether additional rate increases will be needed as experience continues to emerge. Genworth also issued certificates in Maryland through employer groups from December 2006 to March 2016 under policy form number 7046MD and certificate form number 7046CERT-MD. We are seeking the first rate increases on these certificate forms in the amount of 65.1% for all certificates. Acknowledging Maryland regulation, Genworth would be willing to implement the requested rate increases over 4 years with no more than 15% in each year. This rate increase would impact approximately 366 certificates in Maryland. Again, the impacted certificate holders have not received any prior rate increases. We continue to understand that rate increases are a tremendous burden for policyholders and certificate holders. We know this because we talk to our customers all the time. To support our policyholders and certificate holders, we have a dedicated team of specially trained customer service representatives whose sole responsibility is to take calls related to rate increases. Our customer service representatives are ready and willing to help each policyholder and certificate holder understand their options so he or she can make the best decision and course of action for their individual situation. The vast majority of these conversations have led to options where the long-term care policy remains in place. We also have websites that provide policyholders and certificate holders with helpful information on why rate increases are needed, the options that they have, the value of coverage, and also we've developed some frequently asked questions. We continue to offer policyholders and certificate holders subject to rate increases a variety of options. They may choose to pay the full amount of the rate increase and maintain the current level of protection, or instead of paying higher premiums, they may take benefit adjustments to find the right balance of affordability and protection for their individual situation. Policyholders and certificate holders who no longer can afford or want to pay any future premiums and who do not otherwise qualify for another option to maintain the policy while ceasing to pay premiums, we voluntarily offer a non-forfeiture option equal to a paid-up policy. And with this option, if policyholders become claim eligible, Genworth will reimburse eligible claims up to the amount of premium paid minus any claims previously paid. And they'll still have access to care coordination services that the company provides. From our overall nationwide experience based on rate increases we've implemented since 2012, even with a variety of options provided, we have seen approximately 64% of our policyholders choose to pay the higher premiums, which suggests that they understand the value of the coverage that the long-term care insurance policy provides. I hope that the comments today have demonstrated that Genworth actively manages our business to try to ensure that we will be here for policyholders and certificate holders when they need us most, to make sure that we are available to provide the answers they need and to pay eligible claims if and when those needs arise. To date, Genworth has paid over $22 billion to our policyholders and certificate holders across nearly 300,000 claims for eligible long-term care benefits. We are committed to keeping those promises to our customers and paying all eligible claims. But again, actuarially based rate increases or equivalent benefit adjustments are an important component of our ability to do so over the life of these policies. Genworth is in a unique position relative to other carriers with a material long-term care concentration. Almost 60% of our total reserves back long-term care liabilities, and that is projected to increase to approximately 70% by 2023. Any reserves that are released due to policyholder elections, including elective terminations or reductions of benefits, are used to support the long-term care business. Recently, this has included increasing reserves on this product due to changes in assumptions. Genworth does not anticipate using any capital or collected premium from anything other than paying current and future long-term care claims. The company has not contributed any dividends over the past 3 years to its parent company. The last dividend was paid in August 2015 in the amount of $7.5 billion to Genworth Holdings. Genworth Financial has publicly informed its investors on multiple occasions that it assigns no value to Genworth Life Insurance Company. So management does not anticipate Genworth Life Insurance Company will pay any future dividends to its parent company. Genworth is in the process of being acquired by China Oceanwide, a privately held company based in Beijing, China. Upon finalization of that acquisition, Genworth will operate as a standalone subsidiary of Oceanwide, with our existing management team continuing to lead Genworth. Policies will be serviced the same as they are today. Customer information will be protected through the use of a third-party service provider. So in conclusion, Genworth remains committed to working with the Maryland Insurance Administration to implement actuarially justified rate increases in a reasonable and responsible manner, keeping in mind policyholder interests and concerns. Commissioner Barain, Genworth appreciates the opportunity to participate in today's hearing, and I'd be happy to answer any questions from you or members of your team.
Thank you, Ms. Arlen, for that presentation. I personally do not have questions, but if there are members of the Office of the Chief Actuary, do.
I do. This is Todd. Thank you, Ms. Arlen. In looking at a couple of the filings and refamiliarizing myself with some of the details, one thing that came to the front was the investment income component and the expense component. It seemed that, again, after a few samplings, investment income represented over the life of the policy roughly, well, expenses first, roughly about 22% of premium, and investment income about 46% of premium. Would you find that to be somewhat, certainly there's a range on that, representative in your estimation?
Yeah, a couple of things that I would think about as it relates to expenses and investment income. As I mentioned, from a company perspective, we are managing the company mostly for the benefit of policyholders. So as we're earning interest on the reserves that are backing the liabilities, those contribute to the continued payment of current and future claims. As it relates to the specific percentages you are referencing. I don't have that on me at this moment, but I can answer a question as it relates to how that may impact the rate increase request and how we, consider that from the rate increase request perspective.
I appreciate that. And just for more context, and we can pick up on this later, I know we've had conversations about 100% loss ratio, bringing in the two key components of claims and income, just trying to bring the other two key components of expenses and investment income to round out the picture. So yeah, I'd appreciate that down the road. And my last question is related to the merger. I understand in a few weeks, the next milestone date, November 30th, is predicated a bit on, at least as of the last earnings call. As far as approvals needed, I understand that North Carolina has extended its approval to January 24th, so you're all set there. The last I heard is that you're still needing the Delaware Department to weigh in. Has there been any further developments, or are you still needing some approvals or action from the Delaware Department, please?
Okay. As it relates to the status of the Delaware Department on the approval, Delaware has approved the transaction and it has not expired. Once Oceanwide has finalized the funding plan, we would need to confirm that the transaction may proceed under that existing approval. But based on our discussions, we believe they will provide that confirmation.
Thanks again.
This is Jeff. Ms. Arlen, my question is, the Flex product looks fairly new. So my question is, where were the original pricing assumptions from? And how do you ensure updated assumptions are more actuarially sound?
Thank you, Jeff. Yeah, as it relates to the Flex product, as I mentioned, that product, was offered between November 2011 and September 2014 in Maryland. And, looking back to the original pricing assumptions, some of the things where we saw, as some of the drivers of the rate increase, as I mentioned, we're pooling information from relevant and similar products where we have seen actual claims experience emerge over the last few years, especially since 2010, where we've seen claims information double on products that were priced very similarly, where we have pursued larger rate increases historically. And what we're trying to do here with the Flex One product series, as we're looking at the margin that was anticipated in the original pricing, that has we have exceeded that margin for adverse experience from the original pricing. And as we're looking at some of the experience on older blocks, things like claim costs driven by the incidence and termination rate, as well as benefit utilization that we have seen on more recent experience has deviated from what we had assumed in the original pricing. So what we're trying to do is act proactively on this block to request rate increases early while policyholders are still young, to make sure that we can hopefully prevent as much of rate increases in the future. As we think about that block, and maybe to tie your question to Todd's question about investment income, we at Genworth, we've talked to the department on several occasions about our overall block. We're talking about these specific blocks today, the Flex One and the Genworth group. Thinking about it as a whole, several of our older blocks, we manage those to loss ratios well over 100%, like as Todd mentioned. For this block in particular, the Flex One in particular, we are trying to manage this block to have some level of profitability. And as we think about the overall portfolio of long-term care, it's really not feasible to manage a company where all of our blocks have loss ratios over 100%, meaning that we are paying more claims than premiums we collect across the board in all of our products. So because this block is a younger block, we are trying to manage it closer to the original profitability and a loss ratio of about 70%.
Thank you.
I had one question. This is Adam Zimmerman. With regard to the opening comments, I'd spoken about there potentially being a shift in care from nursing home care to at-home care. I was just wondering two things with regard to the COVID-19. I know you had mentioned it earlier in your commentary, but and 6 months of 6 months of this potential claims that doesn't draw long-term conclusions. But is it safe to say that there's an increased or shortened for nursing home settings? Have you seen like a shortened claim length due to increased deaths because of COVID? And secondly, has there been a shift, at least that you're seeing, to at-home care? And if so, based on historical experience, how does claim length for at-home care compare to, in a nursing home setting? You're on mute.
I'm sorry.
Yeah.
I was talking to myself. I'm sorry. As it relates, the sound has been horrible today. I really apologize.
It's okay.
So as it relates to claim status, most of our claims do originate at home, and it varies by age. So some of our youngest claimants, about 90% of those claims start in the home, versus at older ages, maybe up to 60% of our claims we see happening in the home setting. Versus nursing homes, that can vary to 2 to 10% of the places where we see care being received, depending on age. So indeed, we've kind of seen this shift towards maybe reluctance. What we're assuming is reluctance of policyholders to start new claims, particularly in the nursing home settings, which unfortunately have been extremely horribly hit with COVID-19. But as it relates to our long-term trends, because we do see most of our claims in the home setting already, even with a transition to more claims being in home, potentially in the future, we don't necessarily see that being a material shift to our trend, at least not at this time. Generally, also, nursing home claims tend to be shorter claims. So there is that aspect as well, as you mentioned. Nursing home claims do tend to be shorter than home care claims.
Thank you.
Did I answer all aspects of your question?
Yes, thanks.
Any additional questions from the MIA staff? All right, hearing none, Ms. Arlen, thank you very much. Thank you for your perseverance. So we all appreciate the difficulty with technology. We've all been there. So thank you today.
Thank you.
And with that, let me move to, we had a number of individuals who requested the opportunity to speak today. Some of them did provide written comments, which are available on our website, but I'm going to go through the list, and I'm just going to go in the order in which the folks indicated that they wanted to be heard from, and I will call on people, give them the opportunity to speak. The first person is John Roach. So, Roach.
And the number of new people that have been hired into the federal government.
Excuse me? Okay. So, Mr. Roach, are you available? Would you like to speak today?
Commissioner, he may have called in. Let me unmute the callers real quick, and then,
Sure.
then we'll see.
There is actually, his name is actually displayed, I believe.
Oh, okay. Mr. Roach? I don't see.
So there are the caller numbers, but then Mr. Roach was at one point, I thought I saw him on there.
Yeah, I don't see him now, but let me unmute the callers real quick.
Sure. And for those of you who are call-ins, if you make sure that your phones are on mute now that, because you can do that individually, to control your own mute function, except for Mr. Roach.
Okay.
So, Mr. Roach, are you there?
Still going down the list here. Let's see. Mr. Roach?
So I'm going to move on, but Mr. Roach, if you're on the line and you're just having difficulty, if you're able to type into the chat room that you still want to speak and that you're there, we'll do our best to figure out a way to let you do so, so we can hear from you.
Mr. Roach, can you hear us now? No, okay.
Okay.
Excuse me.
So while we're waiting to see if Mr. Roach types into the chat and we can figure out a way to get him heard, let's move to Dr. John Taylor.
Okay, and you're unmuted, Mr. Taylor, Dr. Taylor. Dr. Taylor?
I do see you here, and you're not muted, but it's okay. You don't have to speak, and we do have your comments. But if you do want to speak, this is your time. Okay. And if for some reason you can't be heard, or there are technical difficulties, you can type into the chat room. The third person was Howard Benjamin. So is there a Howard Benjamin on the call who would like to speak?
All the phone lines are unmuted, so Mr. Benjamin called in. Should be able to hear us.
And we do appreciate that people did send comments, and when they sent comments, we assumed that they would want to speak, and so I'm calling everybody's name. But it's perfectly okay if you don't want to speak. We do have your comments. We read them. We take them seriously.
Commissioner, Dr. Taylor just commented that he just sent a chat and that his computer audio is not working.
Dr. Taylor, if you would like to, you can move to your phone, and we can hear from you by telephone if that works. And, Craig, maybe you could just type the number into the chat room.
Sure.
And as soon as we see you come on, you can let us know. In the meantime, John DiCello, would Mr. DiCello like to speak? You are on mute at the moment.
Unmute, Mr.
Yeah.
Can you hear me now?
Yes.
Is that Mr. DiCello, or is that?
It is.
Okay,
I think everyone is having the same trouble I'm having. I couldn't get it to unmute. It was telling me that the host had me on mute. I could not change it.
Well, we're happy to be able to hear you now, and so please, we'd like to have the opportunity to hear what you'd like to tell us today.
Actually, I'd like to wait until I hear additional presentations before I offer my comments. So I'd rather do this for other than that.
We'll see if there are any additional consumers that wish to speak, but these are the only companies that are presenting today.
Ah, okay. I didn't realize that.
Yeah, these are the only companies whose rate increases are the subject of today's hearing. So both companies have already presented.
Well, let me mention then that I have been having trouble getting the, first of all, a little background. We have had associations, I think now 5 different insurance companies getting long-term health care in Maryland for 3 of us. Only one of these policies has used, and then not totally, even though that was a policy we bought from other several tens of thousands of dollars policy. The rest of them have never been access to care. We are not able to establish with all but one of the companies what the class is for these. When we talk to them, they're willing to tell us information over the phone, but they're not willing to document. So we have been around now and actually approached this agency administration on one occasion, but it has been years now trying to deal with the changes in our policies. And I realize I can't talk about our individual. but this is a general problem we have. We have Genworth policies. That is one of the companies. They have never accessed insurance. But I was listening today to see what other information. I do have a question with regards to Genworth. That is, are they still selling LTC? But the main problem I'm having is with the insurance companies themselves. They refuse to document what, in some cases, most cases, they refuse to document what classification have on our policy. And the reason that's relevant, they seem to be changing the definition of the classification over what it was when we bought the insurance.
Okay. Well, I appreciate those comments for you, Mr. DiCello. One thing that I would say to you and everybody else on the call is if there are circumstances where you are trying to get information from your insurer and you are not getting the information that you need, that is what the Maryland Insurance Administration is here for. So you can always contact us through our complaint system and let us know that there's information that you've requested that has not been provided to you, and we will assist you in getting that information from the carrier.
Okay, well, I'm sorry, are you done?
Yeah, I was just going to say, obviously there are things that are going to, it's the type of information that's specific to your policy or to your, claim if there's a claim, but we would be very happy to help you if you're not getting responses to your questions about your insurance policies.
So from the internet, I find this is a very common problem, and it actually resulted in some policyholders going to court successfully. That's one of the reasons
You're fading out a little bit, so I didn't hear that last comment.
This is one of the reasons I'm very concerned, because we've seen what we had been told when we bought the policies, what is on the contract as being the classification, has evolved into other definitions and has in practice been used with other. So I get very concerned that this sort of thing has ended in court with insurance companies, including one of the insurance companies, at policy. In addition to that, I did submit a question in this regard to the administration, got a response, but it was a very detailed response and never approached at all the topic of class. A lot of actuarial data explaining why the increased rates were being. And so I didn't expect an answer in this regard, but it's become very frustrating because there are different rates being approved by the state of Maryland for the same designation, which I have been told orally is the classification. And obviously we're in the end worse, which is rather interesting because we've never filed claims. Yet we're being classified differently than people apparently are also, at least some of them are filing claims. So again, I'm not so interested in being specific because I see this as a general problem where other people have actually taken this to court. Why? And I don't see that as an appropriate alternative, particularly if I were to die and my wife, for example, other were left to take care of these positions where they. I'm trying to straighten this out, at least as far as our policy. but I think it's a general issue. And in fact, to some extent, I know it's a general issue.
Well, I appreciate that, and thank you for bringing that to our attention.
And if I could add, please, this is Todd from the Actuaries Office. Mr. DiCello, we've corresponded before, and I have your email. Could I follow up with you so that we can zero in on your specific question?
Yes, I'd be delighted. And the reason I didn't get back to you, Todd, is I thought I had to go back to the insurance companies themselves and try to get something in writing. But frankly, I think you sent me some information about a year ago, maybe it was 2 years ago, I don't know.
Right.
But we have been back and forth, the companies trying to get things in writing. And in terms of how they communicate now, all of them, as far as I can tell, no longer have a chat. They have telephone numbers. You can't get a transcript of it. And there are people who will tell you on the phone what they consider to be the classification, but they're unwilling to give you any advice. So the last thing I'm trying to do before I got back to you was to file a complaint with the insurance company, at least one of them, and try to get something in writing that way before I approach. But I wanted to take this opportunity because, as I say, two of our policies are Genworth. And I think Genworth, as far as I can tell, well, let me say it differently. I think Genworth is in about as good a position as any of the insurance companies out with. We have, I could list all the insurance companies from whom we have bought long-term care for our families. And we have a huge investment in this. And you might imagine, you probably know as well as I. And now we're going to another almost 50% increase. 50% increase. So considerably more than we anticipated. And we're very reluctant to give up the insurance of certain. But at the same time, I'm not sure that it seems to me almost unbelievable that we have contracts in which the word is class. Are you still there?
We are still here.
Okay, I lost my picture right now. If we have audio, that's important. We have two policies in which on the first page they use the word classification. They have 8 pages of definitions. The term class is never defined in the entire policy. And when I call the insurance company, they say it is defined. And I ask them what the definition is. They give me the definition, and I ask for it in writing, and they say. So that's the kind of response we're getting. And your communication, unfortunately, didn't address explicitly this issue. All right, you addressed instead why the actuary data justifies the increase in price. It did not address why they were allowed to apply different increases to different people, different policies, even though they had what appears to be the same class.
So I would suggest, Mr. DiCello, is, as Todd has indicated, let's follow up offline so we can get a little bit more information and a little bit more detail. Thank you for bringing the issue up here. And since you've been in communication with Todd, he will follow up with you.
Okay. Does he need any information from me? Should I give him my phone number on the chat or something like that?
Todd, do you have Mr. DiCello's contact information?
I know for sure that I have your email. I'm not sure if I have your phone number, but I'll start with email, if that's okay.
We have the phone. We have the phone number that you put into our system when you you gave us your comments. So we do have that phone number. It ends in the number 68. Is that
Yes.
you?
Yes.
Okay.
Okay, and I want to emphasize to Todd that it wasn't that I didn't think I had gotten a response, and I would get back to him, I felt, when I had some more substantial data. It's only been in the last year I have moved absolutely not one square in terms of getting anything in writing.
Sure, we understand, and Todd will follow up. So thank you for your
All right, I
comments
appreciate
today.
it. Thank you. And by the way, I think this is a great way to communicate.
Good. I'm
And
glad.
one last comment. I hope the parameters that are being attached to the approvals are going to be transmitted to us policy, because communications I'm getting up till now only specify what the rate is. Now I see on the information you're providing that in many cases that's a approval subject over a period of several years. And up until now, at least, the insurance companies have not been providing that information. So if the rate is dependent on, for example, after 1 year or 3 years, there will be no increase for 10 years. It's one of the options that's being approved. Then I think the insurance companies, when they notify the policy owner, should say that this is your rate increase now, and then starting next year for 10 years, there will be no, because that's important information. It has not been transmitted to me. And I'll stop there. Thank you.
Great. Thank you very much. I think we heard from Dr. Taylor that he is comfortable with the materials that he's already provided and isn't going to speak today. So we do thank you for that submission, Dr. Taylor. And Kathy Quattrone. Ms. Quattrone, would you like to speak today? I'll go back to John Roach just to give him one more opportunity. And Howard Benjamin. Okay, the last person who indicated that they wanted to be heard today was a Miss Sylvia Rams. She submitted an email which we are going to read for her. She is not a policyholder with respect to any of the policies or the carriers that are the subject of today's hearing, but she did have an overarching comment that she wanted to get on the record. So Jeff G. has kindly agreed to read her email. If you would do that, Jeff, that would be great. Thank you.
Okay, this is Jeff G. Actually, Ms. Ram, she has a policy with the Mass Mutual, Massachusetts Mutual Life Insurance Company. So her comment is, I'm going to read that. I am an 82-year-old senior who still has to work full-time to be able to pay for all medical products that I need, including $352 per month for long-term care, along with numerous seniors. I have had this coverage for many years. Prior to my present coverage, I paid for 20 years to a company that went bankrupt and left me in my late 50s, having to take out new coverage. And of course, at that age, it was more expensive. If you choose to raise our rates, many of us will have to start eating bad foods for us because we won't be able to afford what is healthy for us. Some of us will have to relocate because we won't be able to afford where we live now and have to go to the state for subsidized living. I don't sleep at night along with many of my friends who are in the same condition, worrying about what will happen to us if you choose to raise the rates. I have worked since I was 16 years old and paid for my old age. You will make whatever time we have left into a nightmare. So please do not raise our rates. Thanking you in anticipation that you will take care of us, senior citizens, and not raise rates. That's it. Thank you.
So thank you, Mr. G, for doing that. I would, in the event that she's online, just make it clear that there are no rate requests increases that we're reviewing today in this hearing with regard to that particular carrier. So I just wanted to underscore that. And I do also want to underscore that the Insurance Administration does take to heart what consumers say and obviously considers, the whole picture, including the impact of rate increases on consumers, as well as the needs, the solvency needs of the companies. So we do appreciate Ms. Ram's remarks, and and we're empathetic to her fears, and we are mindful of them, hers and all seniors who are relying on this product. So I thank her for her comments today. Is there anybody else who is on the line today who did not sign up to testify or to make comments who would like the opportunity to do so? If so, can you I'm just going to give you a minute to put your name into the chat feature so that Mr. I can unmute you, give you the opportunity to speak.
I'd like to speak, but I'm not on the online, only on the phone.
That's okay. What's your name, please?
Mark Gage.
Sure, Mr. Gage, we're happy to hear from you.
Yes, I'm an insurance broker in Maryland and have been doing long-term care insurance for 34 years. And my only recommendation as you look at rate increases that continue to come at us every year is that we try to find a way to guarantee the insureds a little bit better stability, and rather than having them be able to come back to the well with consistency that we seem to see. I get calls regularly from clients similar to the letter that you just read, and it's very disturbing. I think if we can do a rate increase approval to lock down the business and solidify it, that makes sense, but we need to be able to tell our clients in confidence that this isn't going to happen again in 5 years or 7 years or 10 years. They're trying to make informed decisions, that's going to affect them during the life of their retirement. So, in the beginning of your presentation, you talked about one of the carriers in the marketplace had come to you and guaranteed that they wouldn't come back to the well again. And so as you're looking at the request, particularly with Genworth and other carriers that may be coming in next year, I think we ought to look to that type of a model of give us your actuarially sound reasons as to why this needs to happen to firm up the block of business, and then cease the ability to have that rate increase occur again in the future. Thank you.
So, Todd, do you want to address that? Because that certainly does go to the heart, I think, of the philosophy of your group and the MIA in terms of how we try to navigate company needs, long-term transparency for consumers, while at the same time addressing the cap that's in the regulation.
Right. Thank you very much, Mr. Gage, and we welcome your input and your expertise here or subsequent to this call at any time. As Adam said, and you said, I just want to accentuate, with the increased frequency of late, we've engaged with the company about making the policy non-cancelable, and just to make sure everybody's using the same vernacular, meaning once this increases in, guaranteeing no more after that for the life of the policy. As Adam said, one policy agreed to that. But we've had others that have agreed to 3-year, 5-year, 7-year, one company a 10-year. So we keep advocating for that and working with the companies as much as we can, and we'll continue on that front. Some other things that we've looked at that I think in the same vein as what you're bringing up are some exemptions, meaning most of the problem, or in most cases, the problem is skewed toward the unlimited benefits, the inflation 5% compound, and ask for the ones that have no inflation, for example, to be exempted out, or 2-year benefits to be exempted out, for certain long elimination periods to be exempted out, or some issue ages to be exempted out. So many carriers have worked with us to varying degrees to explore every option at our disposal to provide certainty and relief for those where the problem is not the prime source, while having a holistic view too. So those are some of the things that came to mind. It's not exhaustive, and be happy to talk about them further, but to give you a flavor.
Yeah, no, I appreciate you trying to be creative. It's just when you're dealing with clients that are maybe in their 60s now that could conceivably live another 40 years, to have no assurances at all that we're not going to have another 50 to 70% rate increase 10 years further into their retirement on top of the 50% rate increases now doesn't do much. And, the insurance companies obviously actuarially screwed up with a 5% compounding interest and what that was going to do to that bucket of money that became available and is now being, spent. I think that the clients that bought that were concerned about, inflation and the costs that were going to, of what they needed to, pay the claims when they reached the claims, and for them to be penalized because the actuaries on the insurance company sides didn't understand that well enough, I guess, is hard to swallow, hard to explain to a client why they should be penalized now because they had some forethought then.
Yeah, I think we all appreciate that concern, and as you know, it's the balancing act between that and keeping companies solvent.
Yes.
Right, and some companies have, of their own volition, agreed to lifetime loss ratios as high as 120%, and we have appreciated that and tried to strike that balance, all things considered.
Yeah, you wonder where the end is because, they first came to us and said, well, we got persistency wrong. We thought it was going to be 88%, and it's more like 98%. Then they said, well, we got claims wrong and morbidity wrong, and we missed some of these things, and we didn't deal with dementia and the fact that was going to be underwritten right. And now we have to have a claim increase because we didn't anticipate low interest rate environments for as low as they've been in the last few years. There shouldn't be many more moving pieces left. So you'd think that we should be able to structure rate increases that are going to be done at this point. You'd think that over the next 30 years, interest rates would start to come back up. My guess is if they do, we're not going to see insurance companies lowering those premiums that are going to get locked in because of the interest rate environment we're in right now. So I'd just like to see some stability. I'd like to be able to turn to clients in confidence and say, yes, Maryland increased the rates, but if you agree to pay this, that's it. This is as high as they're going to be able to go. And I would encourage you to continue to push along those lines. I'm also frustrated that years ago we set the 15% bar in, allowing insurance companies not to have to go through this process if they're willing to just hold a 15% rate increase every year. You got somebody in their 60s or 70s and they're going to have 15% bump up every single year for the rest of their life, conceivably. That's not real comforting either.
Understood. And we're also looking to, any way we can, including other states, for the best ideas.
Well, if you'd like to have an additional conversation down the road, I think you've got my email from previous interactions. So.
Absolutely. They're always happy and open.
Be glad to assist. Thank you.
Thank you very much. Is there anybody else who is on the call-in line who would like to be heard today? All right, going once, going twice. I don't see anybody new in the chat function, and we haven't heard from anyone, so I'm going to assume that everyone who wants to be heard today, who equipment is functioning, has been heard. I, again, remind people that we will keep this record open, so if there are additional comments that you want to make, the record is open through November 25th, which is a week, I believe, from today. Yeah. So I want to thank everybody from the companies, but also from the consumers who spoke today. Your comments are very important to us. They do make a difference. And again, you have our contact information if you need it. If you're looking for a copy of the transcript of today's proceedings or to watch the video or the audio, again, you can go onto the MIA's website. And if you look at links and you click under long-term care, you'll be able to access that. So with that, thank you to my team and my staff, and I hope everybody has a great afternoon. Remember to wear your mask, wash your hands, watch your distance. Stay safe. Thank you. Bye-bye.
Thank you.